This course is about audit practice and ethics. So ethical conduct and codes of professional ethics, or ethical standards and codes of professional ethics, is the key aspect of the model. So we want to look at ethics, the standard, and then the key codes of conduct which is required of any auditor. Now, we'll be looking at the importance of the auditor being independent from the client, rules-based and principles-based approach, corporate governance. We've touched it on the other side, so we'll just quickly run through and then we'll move on, all right? Then we'll look at key ethical principles and the threats that will compromise ethical behavior, the role of the ethics partner, and any various prohibitions which will serve to maintain auditor independence. And then roughly one run through contingency fee arrangement, provision of non-audit services, and then the rules relating to money laundering and insider trading, and then whistleblower and public interest issues. All right. So the auditor actually has a kind of conflict. The conflict here is that they must manage the pressure from the client's management. Their audit fees is coming from the company, the non-audit fees. But at the same time, they must also maintain their reputation, apply or comply with regulations, and make sure that personally each individual auditor has a higher reputation and the company itself has a higher reputation. So this is where the conflict comes in, where to maintain the balance between the two, right? Now, ethics is no morality. Ethics is no morality. So, for example, somebody smokes. In a religion, they might say this is immoral. Somebody is promiscuous, they will say this is immoral. Somebody drinks, they will say this is immoral. But it's different from ethical code of conduct, okay? So the fact that somebody drinks does not make it unethical in the scope of audit or in the scope of pedagogy, okay? So don't confuse ethics with morality. At least this is not religious studies. This is not religious studies. If it's religious studies, it's a different ballgame altogether. Now, so ethics deals with some code of conduct pertaining to a particular group or a particular discipline, which you must abide by, okay? Now, to retain the credibility is important for accountants. So we must act within this particular code which governs us. The Institute of Chartered Accountants, England and Wales, Institute of Chartered Accountants, Scotland, Ireland, ACCA, name them. They all have this framework they abide with. It doesn't change. It doesn't change. Let me see. I wouldn't say it doesn't change. My just doesn't change. It's the same fundamental principles we are all using, okay? Now, the approach is not rules-based. It's principles-based. It's a principle, okay? Now, you would have understood from your corporate governance understanding that when we talk of rules-based, certainty is there. There's definite prohibitions capable of interpretation. It can't deal with any situation. It is inflexible. But when you come to principles-based, flexible. You can fit it to meet the needs of any changing situation, right? It can be applied across borders. It lies on you, the auditor, to consider everything, okay? To consider everything and then take a firm decision. It could also include specific prohibitions, and of course, it lacks precision. So it could cause somebody to misinterpret it or interpret it according to his own whims and caprices. So typical example of a principles and rules-based, again, I'll quickly walk over this because we've looked at it under the corporate governance section, advantages for a conceptual base or principle base. It's flexible, can be applied across borders and so on and so forth. With the rules base, provides certainty, contains definite prohibitions, and then the disadvantages for principles-based, lack of precision, and requires judgment on the part of the auditor, unlike the rules-based where we have to interpret it, and it cannot deal with every situation. It is inflexible. All right. The International Ethics Standards Board for Accountant, i.e. ESBA, is the professional ethics body which helps us to, it works with the IFAC, okay? It's actually located within the IFAC, International Federation of Accountants, and they have set out these 5 principal ethical principles. So integrity, be straightforward, be honest. Don't mislead somebody with your report. Objectivity, lack of bias shouldn't play key role. You should not be intimidated. No undue influences should cause you to write something, which is not true. Competence and due care, update your knowledge to the current standards, okay? Be competent in your area. If you don't know, learn. Confidentiality, in course of the job, if you find any information, don't leak it out. Don't use it for your own personal benefit or for family's benefit. Be professional behavior. Don't speak anyhow. Don't go and boost and tarnish the image of the profession. Don't think that your personal life has no effect on the professional life. So I'm an abusive guy, and I think that is it. It is my personal life. No. When the profession finds out that you are tarnishing the image of the body, you could be sanctioned. So professional behavior is quite important. Now, the IFAC, the IASBA Code of Ethics provides key features to apply compliance with, to assist compliance with ethical codes, so accountability with regard to the wider public interest. Do what is right. To be held accountable. Take over the goal. Integrity, be honest, be true, be fair. Objectivity and independence, no impartiality here. Don't be affected by bias or prejudice. Competence, be professionally skilled. Rigor, thoroughness in your approach to your work. Clear and effective communication. Clearly express your opinion without fear of favor of foe or friends. Association, allowing reports to be included in a larger document as long as there is no inconsistency. And then provide value in terms of quality of reporting, reliability of your report. These features will assist you. Now, we have four main FIMA is not part of the RSB, Responsible Supervisory Bodies. Now, so for ACCI, CAW, ICAS, CAI, in terms of the ethical codes, there may be slight differences, but they are all the same. They are all the same, okay. So, for example, ACCI, CEO have a code which includes objectivity and integrity, but not independence as a separate item. They also included 3 other ethical principles derived from the IASB code: confidentiality, competence, and professional behavior. Okay. So independence is taken as a function of what? Objectivity and integrity. So it isn't clearly spelled out in one of them. I mean, if I'm independent, I will not be biased. I will not be influenced by any opinion, okay? And if I'm independent, I mean, I will not mislead somebody. I will speak the truth as it is. Okay. Safeguard within the profession. We always want you to update your knowledge. Entry requirements into these professional bodies is very strong. Corporate governance regulations are there to safeguard us. The profession has its standards. They will monitor the kind of work you do, and there are always peer reviews or external reviews that take place. Now, within the organization, the audit firm, there will always be a review and control functions, quality control. They will rotate you. You will not always be on the same engagement. We will also consult third parties for their opinions, and disclosure of services provided and fees. Full disclosure is always required by the audit practice so that we will be sure that we are safeguarding ourselves against any ethical breaches of any ethical code of conduct. There are 5 main threats to this independence or an auditor's independence. It's self-interest. If I have a financial interest in the client, I have shares, or a family member of mine has a share, has some interest in that company, any financial interest is a threat. You will not do the work well. Self-review. I prepare the accounts and I audit it. I'm auditing my own work. Or my brother prepares the work and I go and audit. It's the same thing. Self-review. Advocacy. You cannot represent your clients at tribunals or advocate for them or market them. You can't, right? Familiarity. You are too close with this guy. You become like a family. You know him. You've audited him for 5 years, 6 years, 10 years, and you are still auditing him. You sometimes go to the pub with him, to the football stadium with him. Too close. Familiarity trait. You will not be in a position to do a good job. Intimidation threat. When you are being bullied, you are being threatened that if you don't prepare the account this way, you will not get your bonus. It's a threat. All right. Now, independence must not only be seen to be existing, it must actually exist. Okay. So we want to see the actual thing happening. So auditors must approach the assignment with an independent mind, and they must not only be seen to be independent, they must be independent. They shouldn't compromise in any way. So auditors should consider their independence from the perspective of an objective, reasonable, and informed third party. It's an important principle. It is much more stringent than the previous ethical standards. Now, who is an objective, reasonable, and informed third party? There's no perfect definition, okay? But it is seen to be somebody who understands the role of the auditor. The shareholder, for example, the banker is somebody like that, okay? Okay, but not the auditor itself or the accountant. So anyone who sees the auditor in the light of doing his work independently, okay? Ensuring independence, there are three-step approach. Identify the threats, evaluate how significant these threats are, and then safeguard, plug in safeguards to eliminate or reduce the risk to an acceptable level. We can eliminate risk in audit, but in reality, risk cannot be eliminated. We reduce it to an acceptable level, okay? But for external audit, we can always eliminate that risk. ISA 220 brings on board quality control for an audit of financial statements. So here you find that we have some key guys, quality control audit partners normally, who would always ensure that the relationship between the client and the auditor is reviewed on a continuous basis to be sure that there's no threat to independence. So that is the quality control dimension. Confidentiality, every information you derive and cause of your work is confidential, keep it. There are exceptions, unless the court asks you to present this, or unless you think this one is in the interest of the public, okay, or it is required by law, or where the client is not considered to be a proper person to carry out business. This guy is providing financial services, but in reality, he's not licensed to. You can't disclose it. You can't disclose it. And in situations like money laundering, terrorism, drug trafficking, anything, child labor, you can't disclose this one. You can use it. It doesn't breach confidentiality. All right, so quickly, we run through some tricky areas. What if the auditor depends so much on the client, on one client, for money, for his fees? That is dangerous. That's dangerous. So that you generate 30%, 40% from one client in terms of your annual income. It's tricky, right? Auditing our own account, I've said that it's not the right thing. Sometimes you find audit firms, the advisory will go and prepare the accounts, and then the audit section will go and audit. It's a tricky area. It's not the best. Don't promote your clients. Familiarity, don't be too friendly with the client, okay? Intimidation, threats of loss of business. Sometimes the client will tell you, if you don't do this, next day we'll change you, getting new auditors. It's a threat. Don't be moved. What if you are threatened by legal action by the client? The auditor may lose impartiality in report. It tells you that you want to report, I'm going to take you on because what you have reported may cause my share to drop. Now, you must also avoid acting for both sides, conflict of interest. Be very objective. Now, look at it in terms of the fees, the tricky areas. There's a 15% rule. Your income that you generate from the one client should not exceed 15% for the whole year. If the whole year my income is 10,000, let's say 100,000. Okay, let's go for 100,000. That 100,000, 15,000 of it shouldn't come from one client. But if it is a listed company, then 10,000 must not come from one client. Gross income, not the net income. So that's a 15% rule. For public interest entities, the level of fees for non-audit services must not be greater than 70% of the average of the audit fees for the last 3 consecutive financial years. Interesting, right? Financial Reporting Council requirement is for fees above 5%. In that case, the engagement partner must disclose to the ethics partner or senior partners. Now, any unpaid fees may be considered as a loan to the client. So make every attempt to collect it as an auditor, collect it. Now, you cannot accept percentages. It tells you that I'm going to pay you 5% of my net income as your audit fees. We can't do that. We can't accept that. It should be based on the hours we put into the job and the number of days we spend on the job, okay? There's something we also call lowballing. Everybody is trying to tender for the audit. Everybody's charging like 20,000 and above, and you decide to charge 5,000. The client will come for you. Then next year you increase it to 7,000. Then subsequently to 12, to 15, to 20. Lowballing must not be allowed. What about a self-interest item? You have close connection with somebody in the company. It could be your spouse, your child, your minor, your family member, where you hold more than 20% interest. You can't have a beneficial interest in shares of a client. Be careful. Be careful of that close connection. If you are connected with a practice, you're a partner, person connected to a partner, employee, that is also something you need to, it's a threat to your independence. These are not exhaustive. There can be more, okay? There can be more. Close friend, your in-law, a good classmate, okay? Self-interest, threat, staff movements. So if an audit partner or manager joins the client, there should be a change in the audit procedures and auditing. There's what we call the 2-year rule. If a member of a client joins the staff, if a member of the client staff joins, the auditor can't use him on that client within 2 years. So I work with company A, I joined the audit firm. I can't go and audit my previous employers unless after 2 years. You cannot lend, okay, prohibition on lending staff to audit clients. You can't say, I'm giving this, my auditor is very good, help him to fix his account. You can't do that. Corporate hospitality. It is sometimes reasonable, acceptable that you visit the client and they offer you some gifts, some hospitality. But make sure it is not significant to impair your judgment. It's trivial, inconsequential, okay? Now, the safest rule is that don't accept it. But there are some cultures where it will be offensive. You don't accept such gifts from the client. Okay? But in any case, disclose it. Make sure the value of the hospitality is not quite significant to impair your judgment, okay? Attention should be paid not only to the actual value, but the perceived value. So I buy a ticket for you to go and watch the Liverpool match at the VIP. Maybe it's just £100. But the treatment that you are being placed in a Liverpool seat, VIP seat, is what we should consider, not the £100 amount, okay? Financial interest, again, still on the risky areas. You can't have interest in the shares, like I've said earlier. You can accept loans from clients, okay, whether on commercial basis, unless it is a licensed financial authority or financial company, services company, which is providing you on a commercial basis at an arm's length transaction. Okay. Again, you can accept gift unless it's insignificant or unless it will breach culture or it will offend the person. Now, you can have 2 or more clients where interests may conflict. What do? The work of the audit must be managed to ensure that the interest of one client doesn't affect the other. So they can be competitors, same industry, same year, and make sure you manage them perfectly. If you can get 2 different teams to manage them, that would be great. Or to audit them, that would be great. Now, if acceptance of appointment will materially affect the interest of any client, it must be declined. It must be declined. Protection against conflict. Rotate the engagement partners, different partners on different engagement teams. You must provide clear-cut instructions for the auditors not to leak information. They must be very confidential. Audit partners must be reviewed. Don't leave them alone as if they are gods on their own. You review them. Now, you must also tell the client that they can seek independent advice if necessary, if they need it. Okay. So prohibitions, some are by law. Okay. Now, prohibitions apply in the case of all listed companies, including the public interest entities. Now, either they involve some element of decision-making on behalf of the client, or the outcome would have a direct bearing on the financial statement, which the firm would then go on to audit. Some prohibitions will apply to all the clients, okay? So participation in management decision-making is a prohibition, applies to all clients. HR services like sourcing management staff, this applies to all clients as well. Internal audit services, this applies to all clients. Bookkeeping and accounting services, it involves some judgment. If you can get separate independent teams, do it. Designing and implementation of internal control and risk management procedures for 1 year before you begin to perform the audit. I do it this year, then I go and audit next year. It's a prohibition. Payroll services, it also depends. You could get 2 separate teams which are purely independent from each other. IT services, where the systems involved are part of the financial services relevant to the audit, prohibited. You can't design a system which you are going to audit. Litigation support, like simple provision of information or actuarial services, there are some prohibitions, okay? Especially when you want to audit them. Certain tax services, where you are going to audit this same thing, there could be prohibitions. Financing, capital structure, investment strategy might also involve some elements of decision making. So be careful if you are involved in it. Loaning your staff to clients is now currently generally prohibited. You cannot do that. Now, listed company rules. Engagement partners must be rotated no more than 5 years. So, and return after 5 years. If the company you're auditing is listed on the stock market, the engagement partner will be with them 5 years, rotated. Cannot come back again until after 5 years. Other partners, other people responsible for engagement quality control are to be rotated no more than 7 years and without return for 2 years. Other guys, you can be on it for 7 years, we'll rotate you, you can't come back until after 2 years. Intimidation threat. If you are intimidated by the client, seek a second opinion. Now ensure that the opinion you are seeking is based on facts, figures. Okay. Now the safeguards. Contact the existing accountant or auditors. Explain any limitations on the opinion and give existing accountant a copy of whatever intimidation threat you are receiving. Now, if the client refuses that, do not go and contact the other outgoing accountant or auditor. Don't take up the assignment. Don't take up the assignment. Okay. Review, quite important here. We're wrapping up. So audit firms should have internal procedures to ensure that processes are regularly reviewed and quality is maintained, especially for the listed clients. Now, risk evaluations must be carried out when we think that independence may be compromised. Now, consider the size, the expertise in the auditor practice, in the audit practice before you go on for any engagement. KYC, know your clients, as per money laundering regulations, and so you must demonstrate that the client is genuinely who they claim to be. Okay. Voluntary reporting, if it is in the public interest, and you think whatever you found out will affect the public is quite serious, then report to the relevant authorities. Again, in the case where you have to defend yourself in the courtroom, you can protect your own interest by voluntarily reporting these things. Okay. Non-governmental organizations having statutory bodies, you can always voluntarily report to these. There's some elements of money laundering, which I wouldn't hit much on. But money laundering, there's a whole task force on money laundering set up by the G7 countries. We already have a money laundering officer who is in charge of money laundering. In fact, at the country level, we have a whole act, Proceeds of Crime Act 202, and then the Money Laundering Regulation 2017. And so anything you identify in terms of, it was amended in 2019. Anything you find in relation to money laundering, report to the appropriate authorities. Okay. Any criminal property acquired by the clients, report it. Tax evasion, not avoidance. Tax evasion is criminal by nature. Bribery or corruption, saved costs from criminal failure to comply with the statutory requirements. These must be reported. The offenses are concealing or disguising criminal property or removing it from jurisdiction of the court, acquiring and using or possessing criminal property, and tipping off our crimes. Okay. So like I said, we have the money laundering officer. So possible auditor offenses: failure to appoint a money laundering officer, implement control procedures in relation to money laundering, undertake customer due diligence procedures, make a suspicious report to the National Crime Agency, comply with the direction not to proceed with a transaction or relationship, maintain proper records, or offenses that if you come across, you must report. Otherwise, you could be in hot waters. Okay. So what does the money laundering officer does? He's a senior, experienced guy. If unavailable, there must be an assistant, a deputy, and must liaise with their colleagues and receive reports and must make full reports to the NCA. Okay, the Crimes Authority, National Crimes Authority. All right, so quickly running through. So what am I saying? What to do, set up internal controls, appoint an MLR officer, establish systems for verifying the client's identity, set up any internal suspicious transaction reporting. Whistleblowing is key, okay? So running through this quickly because it's not really an examinable area. So there could be danger signs you might look out for. Look out for suspicious transactions, large cash deposits, foreign currency transfers, overseas arrangements, offsite accounts, offshore accounts, dummy companies, loans are paid in cash. Loans in cash are repaid in cash. If you want to commit fraud, the best thing to do is to go for cash, So you can always get there. Small entities. What is the definition of a small entity? You remember the micro, medium, small entity, large entity. Okay, so I will leave this one for you to go and rule. Realize that I put some question marks here. Okay, the turnover 6.5, asset 3.26, employees less than 50. Is it? What about this? You remember the large company 75%. 750 rule, right? So principally what I'm saying is, what is the definition of a small entity? I'm not really interested in this. I'm more interested in the ethics that I was highlighting, okay? Okay, what about ethical standard on audit of small entities? You must say so. It applies to you whether you're auditing a big company or a small company. Unless shareholders are familiar with these rules, this is of little practical value, but does, of course, protect the auditor. So it doesn't matter whether you're auditing a small company or a large company, the ethical rules still apply. Beautiful questions are online. You could check them and then get a very good understanding of how ethics operate. Remember the 5 ethical principles. Confidentiality is there, right? Objectivity, integrity, professional behavior, professional competence, and due care. And then look at the threats of confidentiality, self-review, self-interest, okay, intimidation, familiarity. All right, so then you should have a very good understanding. Any exams, you don't need to quote this. You can describe the scenario, and that should be enough or sufficient for you to score any full marks, okay? Look at the scenario, the case, and you always see the ethical issues there. All right, thanks for this, and I'll see you when I see you. Bye.